Hello, my name is Greg Agnatowski. Today I'll be talking with you about the ethical and legal limitations of using credit scoring to determine what rate insurance customers pay. To begin with, let's talk about what a credit score is. A person's credit score is a numeric representation of how a person manages their financial affairs. The score is based on multiple variables, including income, employment, and past credit history. The actual credit score is a number somewhere between 300 and 850. So, why do insurance companies want to use credit scoring? Like any other business, insurance companies exist to make money, and to make money, insurance companies must be able to accurately determine the risk of loss. When a customer files a claim against a policy is when the insurance company takes a loss. How accurate an insurance company is at determining rates, the more money they make. Basically, credit scores help insurance companies create more accurate rates. In a study, the Federal Trade Commission, or FTC, determined the credit scores lead to more accuracy in the underwriting of automobile insurance policies. The study also found a correlation between insurance scores based on credit scoring and the likelihood of filing an insurance claim. This shows the attractiveness of using credit scores when determining policy rates because it provides better accuracy in the insurance company. Since the 1970s, insurance companies have been using credit scores along with other information to determine rates. The Fair and Accurate Credit Transactions Act, or FACTA, which was enacted in 2003 and amended the Fair Credit Reporting Act of 1970, only allows insurance companies to use insurance scores based on credit scores as one factor in the rate of determination. Driving history, age, gender, marital status, location, driving patterns, and vehicle type are just some of the other variables considered when insurance companies determine your rates. Some people may argue that using credit scoring has a disproportionate effect on people of a certain sex, specific minority, groups, or other segments of the population that may not have established credit. 3 separate studies have found this argument to be false. In 2007, the Federal Trade Commission found no evidence that credit scores could be used to determine race, ethnicity, or sex. A separate study conducted by the Federal Reserve validated the FTC findings, and a third study conducted by the Texas Department of Insurance in 2004 found similar outcomes when it came to predicting race or sex based on credit score. Credit scores just cannot be used to determine this type of stereotyping or prejudice. Another criticism is that the use of credit scoring presents an unnecessary risk to the consumer and their privacy in general. Data breaches of computer systems could compromise customer information, which would be costly to the insurance companies both fiscally and reputation-wise. The Fair Credit Reporting Act specifically authorized their use in insurance credit scores. The Fair and Accurate Transactions Act, which was discussed earlier and enacted in 2003, allows insurance companies to use insurance scores based on credit scores as one factor in the rate of determination. The FCRA regulates the use of consumer credit information collection methods and dissemination. The FCRA provides numerous consumer protections, including the right to obtain a free copy of a credit history if an insured is adversely affected by credit information, and the right to dispute incorrect or incomplete information. Violators of the FCRA face civil liability of a minimum $100 and a maximum of $1,000 plus attorney fees and any punitive damages. Now, there are some legal cases that have arose due to the use of insurance scores based on credit scores. And insurance companies that misuse credit information face costly legal situations and tarnished company brands. An example of this is the court case of Geico and Safeco, where they offer better rates than possible due to the customer's credit score. In the Geico case in particular, the insurance company had developed a way to help them not be required to notify consumers their credit score had negatively affected them. Initially, the insurance companies won the case, but eventually the Supreme Court overturned the decision and ruled on the side of the consumers. The point worth noting is that regardless of the outcome, the company had to spend millions of dollars defending the case that could have been better spent elsewhere. On top of the actual penalties, the company reputation took a negative hit, and defense spending could have been spent in more productive areas. Multiple consumer groups exist that monitor the insurance companies and make sure they do not violate federal and/or state guidelines, which is an added protection to the consumer. Now, there are some ethical implications to using credit scores in determining insurance rates. They're pretty wide-ranging. For example, due to the recent economic downturn, many individuals face financial hardships and probably lower credit scores. This doesn't mean those people were financially irresponsible. It could mean the leadership of their employer was financially irresponsible, but those people that lost their jobs and have lower credit scores now face another burden: high automobile insurance. Another example would be unforeseen medical bills. Medical bills are the #1 cause of bankruptcy in America, and these people don't fit the poor financial management model either. The studies previously cited show that the credit scoring model works because it predicts risk based on people with poor financial management. This means these people are being unfairly charged higher rates, and ethically this is wrong. Another ethical implication is if customers' credit scores become compromised by a hack of insurance companies' systems or other release of customers' credit information, all of society will suffer a loss or decrease in faith in the overall financial systems. Insurance companies are large organizations with tremendous reach, and everybody knows who State Farm, Allstate, and Geico are. When companies everybody knows like this suffer breaches in security and people realize their information isn't safe, it can cause panic and tremendous overall harm to society and their trust in not only the company, but also the financial system as a whole. This could possibly cause them to not invest in companies or not use credit, which would adversely affect the whole economy and society. Distrust of insurance companies can be a negative outcome from the use of credit scores as well. Many consumer groups are battling the use of credit scoring in the courts, and the more attention that receives, the more consumers may take notice. If consumers get motivated enough to change what's going on with their credit scores, it could be a big blow to the insurance companies. A competitor could emerge that doesn't base rates on credit scores and take much of the market share from the larger organizations that have spent millions protecting the ability to use their credit scores. This could suffer a tremendous blow to those larger organizations. In the future, to minimize the ethical risks, they should provide more information to the public regarding their use of credit scores. Look into a way to make sure they're assessing higher rates to people who truly manage their finances poorly, and not just someone who suffered an unforeseen event like a medical bill or layoff. Insurance companies should also look into the safeguards they have in place to make sure hackers or other criminals cannot access private customer information, because protecting consumers' information is of the utmost importance. In conclusion, while there are financial and ethical risks associated with using credit scoring to determine insurance rate, it is a legal practice governed by federal and state laws. Insurance companies have a right to make money, and they are not profiting by means that stereotype any segment of society. They are running the risk of damaging their reputation should consumers find out their information is being used incorrectly, or their private information is at risk to hackers or criminals. So they should consider that before implementing further use of the credit scores. And insurance companies need to take steps to safeguard that information and educate consumers on how their credit scores are used, because the more consumers understand how their credit scores are used, the less anxiety they'll feel about it, and the more faith they'll have in the companies and the system in general. That concludes my presentation. I hope you've all enjoyed it. Thank you.